Moving on, Bank of Japan policymakers are increasingly talking up the need to shift away from the massive monetary stimulus of the past decade, even as growing global risk heighten concerns about a fragile economic recovery. A series of hawkish comments by BOJ speakers in recent weeks suggest the bank is preparing markets for an eventual policy change amid growing price pressures in deflation-prone Japan, analysts say. Even dovish members of the BOJ board have expressed an openness to talk about a long-awaited exit from the extremely accommodative policy of former Governor Haruhiko Kuroda, acknowledging changes in conditions may warrant a tweak in monetary settings. Governor Kazuo Ueda told a newspaper interview on Saturday the BOJ could get enough data by year-end to judge whether conditions are in place to raise short-term interest rates. Ueda's remarks, which pushed up the yen and bond yields on Monday, followed those of BOJ board member Naoki Tamura last month that suggested the bank could safely hike short-term rates without hurting the economy. The commentary contrasts in tone to the pro-growth posture adopted under Kuroda, an advocate of aggressive monetary easing to shock Japan out of its deflationary mindset. It also suggests the BOJ under Ueda will be more inclined to prioritize unwinding the Kuroda-era policy framework, which has been blamed for distorting bond markets and crushing bank margin. The BOJ will proclaim that Japan has achieved 2% inflation and a negative rate in April, said Mari Iwashita, chief market economist at Daiwa Securities. To be sure, the BOJ is in no rush to phase out stimulus until there is enough data suggesting the economy can withstand the impact of weakening global demand and allow firms to keep hiking wages, say three sources familiar with its thinking. Inflation has exceeded the BOJ's 2% target for more than a year as companies pass on higher costs to households. Firms also offered the largest pay hikes in 3 decades.